Today's video won't be as polished as normal, so I apologize for that, but it's not the point. I'm going to start out by saying that my heart goes out to the people of the Ukraine. It's a horrible situation that hasn't been seen in Europe since really the end of World War II, and it brings back thoughts of seemingly similar past situations in the Middle East. As investors, we're sometimes so laser focused on our retirement, our investment accounts, that different global factors are just a measuring point. They're another blip on a graph that give us an indication of future changes or where the market might be heading, but honestly, this just feels different. And yes, I'm here giving my thoughts on the market implications related to the Russia-Ukraine situation, but the greater humanitarian effect is both concerning and disheartening. I try to put myself in the mindset of the Ukrainian people right now as I'm watching on TV lines of cars and trucks just trying to leave the capital and other major cities, and it's just a struggle to even begin to understand the fear and uncertainty they must be experiencing right now. But anyway, this is a dividend investing channel, so let's take just a few minutes to talk about what it may mean for the market and what's happened during past conflicts. The largest part of the rest of the audio here was recorded prior to the invasion last night, so you will see a marked difference in maybe the sound of the audio quality and probably even the tone of my voice. So let's get into it. Historically, stocks have largely shrugged off past geopolitical conflicts, as noted by Ben Carlson, Director of Institutional Asset Management at Ritholtz Wealth Management. From the start of World War II in 1939 until it ended in late 1945, the Dow was up a total of 50%, more than 7% per year. So during two of the worst wars in modern history, the U.S. stock market was up a combined 115%, showing that the relationship between geopolitical crises and market outcomes isn't as simple as we might think it should be. History tells us of periods of uncertainty like we're seeing now are usually when stocks suffer the most. In 2015, researchers at the Swiss Finance Institute looked at U.S. military conflicts after World War II and found that in cases when there's a pre-war phase, an increase in the war likelihood tends to decrease stock prices, but the ultimate outbreak of a war increases them. However, in cases when a war starts as a surprise, the outbreak of a war decreases stock prices. They call this phenomenon the war puzzle and said there's no clear explanation why stocks increase significantly once war breaks out after a prelude. Similarly, Mark Armbuster, the president of Armbuster Capital Management, studied the period from 1926 through July 2013 and found that stock market volatility was actually lower during periods of war. Intuitively, one would expect the uncertainty of the geopolitical environment to spill back over into the stock market. However, that's not been the case except during the Gulf War, when volatility was roughly in line with the historical average. In terms of the Iran conflict, however, investors had a muted reaction to the headlines. If 2019 taught us anything, it's that you have to try as best as possible to keep to your process and not get caught up in the headlines. In a sad way, I wonder if we've become used to it. I wonder if the market has learned to discount these events, and it seems to be the case. A conflict with Russia will of course cause volatile oil markets, as Russia is the key producer of crude oil and natural gas, with pipelines feeding many parts of Europe. If Russia were to shut off the spigot or have its oil infrastructure damaged, it could lead to higher energy prices. Interruptions to the port or in the Black and Baltic Seas could also create even bigger shipping headaches and lead to food inflation as grains and other staples remain stuck at sea. And a prolonged situation could lead to issues with precious metals and semiconductors already in short supply globally. My opinion is that investors buying the dip should use a selective overall strategy. I'm not going to stop investing, but I will emphasize quality trades that are anchored by robust balance sheets and high cash flow generation. I know there's a strong temptation to shift away from U.S. assets in favor of international investments, but as a focused dividend investor, I stay away from less liquid market segments that have experienced benefits from extraordinary central bank stimulus packages, and I don't reach for yield and returns. Yes, I will keep a close eye on how things progress, but I will not stop investing. I'll just be even more deliberate in my choices. Again, my thoughts lie on the Ukrainian people and the horrible situation they find themselves in today. I really just hope for a quick resolution and safety for all of those involved. So, thanks for watching today. I know this was put together quickly in light of the rapidly changing events. But if today's video helped you out in any way, I'd really appreciate it if you liked the video and subscribed. And let me know down in the comments what you think about the entire situation, the potential market reaction, the humanitarian side. I'm open to discussing anything, guys. So thanks, and see you next time.